Today I'm going to explain to you how federal taxes for investments work. If you buy a stock and you don't sell, there are no tax implications. Only when you sell is there a tax implication. So depending on the price you pay for a stock, which is essentially your cost basis, and the price that you sell it for, this determines whether you have a gain or a loss on your investment. So let's first talk about what happens when you have a gain on your investment. So the first thing you do when you have a gain is to determine the holding period for your investment that you just sold. If you had held the stock for more than 1 year, then the gains on this investment is considered a long-term capital gain. So essentially, if you bought a stock on February 12th, you would need to sell it on the same date, February 12th of next year, to be considered a capital gain. If you sell it on February 11th of the next year, that would be considered a short-term capital gain. So the federal government gives you a tax benefit if you have long-term capital gains, because it wants to incentivize you for holding on to stocks. So I'm going to pop up the chart for long-term capital gains for the year 2022, and you can see that long-term capital gains are subject to a tax rate of no more than 20%. So if you had held your investment for less than a year, those gains would be considered short-term capital gains. And the short-term capital gains gets added to your ordinary income such as the ones that you make from your day job. They will also be taxed at ordinary income tax rates. So here I bring up the chart for the various federal tax brackets, and you can see that for ordinary income, you could be taxed as high as 37%, compared to a max of 20% if you had held your investments for longer than 1 year. So now let's talk about what happens when you have losses on your investments. So the long answer short is that losses on your investments can be offset against the gains that you have to show lower gains for tax reporting purposes. Let's say you have a total gain on sale of $10,000 for the year, and you also have a total loss of $10,000. Those would essentially net out to zero, and you would not pay any taxes on the gain portion of your sales. So this area often gets very confusing, but I'll give you a 3-step process for how you consider gains and losses. First, you net all your short-term gains with your short-term losses and come up with a net loss or gain. Then you net all your long-term gains with any long-term losses that you might have. And finally, you net your total gains against your total losses, whether they're long-term or short-term, and come up with a net number. In this scenario, you could have a net long-term gain, which you pay lower taxes on, a net short-term gain, which you would pay ordinary income taxes on, or you could be in a situation where after you net everything, you could be in a loss position. So let's say after netting everything, you are in a total net loss position of $10,000. The IRS lets you deduct $3,000 of these losses against your taxes for each given year. So in this scenario of $10,000 loss, you can deduct $3,000 for the current year, and the remaining $7,000 would carry on to future years. That $7,000 carry forward can be netted against gains in future years, or in the scenario you have no gains in future years, you can deduct another $3,000 from this loss until the entire net loss is used up. So that's in a jiffy how taxes on investments work. Hope you guys learned something new. I'll see you guys in the next one.